Welcome back to the deep dive. Our mission today, well, it's pretty straightforward. We're giving you the fast track to understanding maybe the most fundamental financial debate shaping global reserve strategy right now.
Yeah, it's a big one.
It is. It's the oldest store of value meeting, well, the newest store of code.
Exactly. We are diving deep into gold versus Bitcoin. Specifically, we're looking at their roles, as a strategic reserve of value for 2025 and, frankly, the decade ahead.
And just to be clear up front, this isn't about picking a winner, is it?
Not at all, no.
Yeah.
Our goal is to provide you, the informed investor, with a really deep evaluation framework. We're basing this on solid academic insight and verified financial data.
Good, because our sources, they all seem to agree on one thing, the current environment. I mean, you've got increasing geopolitical friction, stubborn inflation, the incredible speed of tech shifts.
It all adds up.
It does. And it makes choosing where to park your strategic wealth a really high-stakes decision now. It feels like it's more than just financial calculation.
Oh, absolutely. It's almost philosophical, isn't it? It reflects where you place your trust. Is it in the sort of permanence of history or maybe the inevitability of the digital future?
That's a great way to put it.
And that focus on macro uncertainty, that's why long-term thinking and prudent risk management are just essential here.
Right.
So we'll break down the history, the detailed risks, the strategic function of both these assets. The aim is so you can allocate capital wisely.
You want your portfolio aligned with data, not just hope.
Exactly. Verified data on how these two assets actually behave under pressure.
Okay, let's get into it then. This tale of reserves. We should probably start with the 5,000-year veteran. Gold, the age-old standard.
Right, gold. Its value proposition is, remarkably simple, but also incredibly resilient.
Tangible.
It's a tangible asset, yes. A physical metal. Its value comes from physical scarcity. Its durability is undeniable. And its acceptance is universal, long-standing across cultures, regimes.
And that key phrase you hear, no one's liability.
That's vital. Gold is no one's liability. It carries zero counterparty risk when you hold it physically.
Which makes it the ultimate defensive position, really. The wealth preserver, proven over millennia.
It absolutely is.
Yeah.
And we looked at some serious academic work on this. Research from places like Dartmouth, Yale University. It confirms gold's long-term effectiveness.
What do they show?
They show it acts as a reliable hedge against inflation, against currency debasement over these really long historical cycles. Gold has preserved purchasing power through empires rising, falling, numerous monetary collapses.
And it's fascinating, isn't it, to see modern institutions basically confirming this ancient wisdom. The data shows that in 2024, central banks,
Oh, you got the buying trend.
led by China, India, Poland, Turkey, they just kept buying gold, near record pace.
That trend, the sustained central bank buying, it's honestly one of the most significant macro indicators right now. It's a clear global movement towards, what we call reserve diversification.
So strengthening reserves, but also something else.
Yes, they're strengthening reserves, but they're also actively reducing their dependency on the U.S. dollar system. It's a strategic play to build an independent bedrock of value. It's very deliberate.
Okay, that sets a massive standard. I mean, if gold's value rests on 5,000 years of consensus, official institutional adoption, how does a digital asset, barely 15 years old, backed only by code? How does it even start to challenge that?
And that's the pivot, right? We move from the veteran to the challenger, Bitcoin, created in 2009. It's the digital pioneer, yes, but interestingly, it seems to have borrowed gold's most successful feature, scarcity, and maybe even enhanced it digitally.
So Bitcoin, BTC, it's decentralized, digital, not physical. And its value proposition is fundamentally different, isn't it?
Completely different. Its value comes from its absolute predictable scarcity, that fixed unchangeable limit of 21 million units.
Hard-coded.
Exactly. This code-enforced supply limit makes it arguably the direct algorithmic hedge against uncontrolled fiat money printing. That's the core pitch.
And institutions are starting to grapple with this.
They really are. What's compelling is how the institutional world is processing it. We saw a really insightful report from Fidelity Investments back in 2023.
What did they argue?
They argued that Bitcoin is rapidly maturing into a unique asset class. It shares those key store of value features we see in gold, but it comes packed with inherent digital advantages. Think programmability, speed, ease of transfer.
But you mentioned its nature is kind of dual. That seems to be where the confusion and honestly the volatility comes in.
Correct. Bloomberg Intelligence noted this dual identity. On one hand, BTC shows a growing correlation with risk-on assets, like tech stocks, the NASDAQ.
So when markets are optimistic, it behaves like tech.
It acts like a high beta growth asset, yeah. But then on the other hand, during really severe, sudden macro stress events, it often acts as a refuge. It momentarily decouples from traditional risk assets.
Interesting. So you buy it because you believe in two potentially opposing things: future tech and the collapse of fiat discipline.
That's a good way to summarize the tension, yes.
Yeah.
It straddles both worlds.
Which makes the practical trade-offs just fascinating, because owning these two assets, it couldn't be more different for the average investor. Let's dig into the practicalities, advantages, disadvantages. Start with gold's pros.
Okay, gold. Proven stability, relatively low volatility compared to Bitcoin, universal recognition, and like we said, zero counterparty risk in its physical form.
But owning physical gold, that comes with real headaches, right? And costs. Secure storage vaults, insurance, that all eats into your returns.
Definitely.
And the liquidity isn't great physically if you needed to sell, say, $50 million of gold bars quickly. Those buy-sell spreads are going to hurt instantly.
True. Large amounts are tricky to move fast physically.
Plus, it generates zero yield. It just sits there. And we can't ignore history government confiscation like the U.S. in 1933. That's a background risk.
A valid historical point.
Yeah.
Now, Bitcoin flips that script almost entirely. Its advantages are really centered in the digital realm.
Like what?
Extremely high liquidity and portability. You can move massive value globally, across borders, basically instantly, 24/7. Then there's the absolute non-manipulable scarcity, purely governed by code. And of course, the potential for really significant appreciation, given its relatively small market cap compared to gold.
Okay, wait. If we're evaluating this as a strategic reserve, for prudent risk management, you mentioned its volatility, price swings of 10% in a day. How can something that volatile be credibly called a stable reserve?
That's the critical challenge. It requires a bit of a mindset shift, I think, that volatility. You could see it as the price you pay or the tax you pay for its appreciation potential and its early stage adoption phase.
So the argument is look longer term.
Exactly. While daily volatility is extreme, its reserve function is measured over years, decades perhaps, not days. The long-term bet is that if you believe that fixed supply mechanism holds, then the volatility is just noise on the path to, well, inevitable value capture.
Inevitable is a strong word.
Perhaps. But you're right to highlight the risks. They are significant. Hostile regulations could definitely damage the price. And the technological risks are severe. Losing private keys permanently, the very real threat of exchange hacks. Those are major concerns.
Right. And those practical risks, especially around holding digital assets, that used to be the main barrier for big institutions, didn't it?
It was huge.
Which brings us neatly to the great equalizer for both assets recently, the ETF catalyst.
Yes. This is truly the game changer, especially for you, the investor, thinking about this. The SEC approval in 2024 of spot Bitcoin ETFs, things like IBIT, FBTC, alongside the established gold ETFs like GLD. It's completely transformed the investment landscape.
Explain why that matters so much. What did it fundamentally change?
Well, before you had to deal with, like you said, the complexities of storing physical gold safely, or the, frankly, terrifying reality of self-custody for Bitcoin managing keys, security.
Right. The fear of messing that up was huge.
Exactly. The ETFs essentially eliminate those technical and, honestly, psychological barriers.
So it makes the decision just about the asset itself.
Precisely. They turn the ownership decision into a purely strategic financial choice. And it's regulatory compliant now, which is key for institutions. Our sources consistently cite the influx of institutional capital through these regulated vehicles.
Making them easy to buy in a normal brokerage account.
Right. That ease of access is seen as the single primary bullish catalyst for BTC heading into 2025. It's shifted from being a sort of hobbyist or tech enthusiast asset into a mainstream financial product.
Okay, so using this new, easier access framework, let's compare them side by side, maybe using two key metrics, scarcity and utility, especially thinking about the macro climate ahead.
Good idea. Let's tackle scarcity first. Gold is scarce, no question, but the global gold supply does increase, roughly 2% annually from mining.
So it's expanding, albeit slowly.
Right, constantly expanding. Bitcoin, by contrast, has that absolute algorithmic, non-manipulable cap, 21 million units. Full stop. And its issuance rate gets cut in half roughly every 4 years, the halving.
That digital scarcity narrative is powerful.
Immensely powerful, especially in a world that seems to be struggling with continuous easy money policies and currency debasement fears.
Okay, scarcity is one thing. What about utility? What can you actually do with them?
Well, gold's utility beyond its reserve function is relatively low. Jewelry, yes, some niche industrial uses in electronics, but generally it's a dormant asset. It just sits there, aiming to preserve capital.
Okay. And Bitcoin.
Bitcoin's utility arguably is significantly higher because it's more than just a store of value. It is a live, functioning network.
What does that mean in practice?
It serves as the base layer, the foundation, for an emerging financial ecosystem. It's powering things like decentralized applications, potentially smart contracts, enabling high-speed international transfers at low cost. It's a productive asset in that sense. It enables other financial activity, which fundamentally differentiates it from gold.
So let's project forward. We look ahead to 2025. How might these distinct value propositions play out under different economic or geopolitical scenarios?
Our analysis, looking across various sources, suggests a pretty clear split based on the, let's call it the prevailing global mood.
Okay.
Gold seems to be the hands-down winner in scenarios defined by extreme systemic pessimism. Think deep global recession, a major escalation of geopolitical conflict, maybe the sudden failure of a large financial institution.
So basically, fear runs high, people run to gold.
It's the default asset for deep-seated fear. History supports that.
And then Bitcoin. When does it thrive?
Bitcoin, on the other hand, seems to thrive more in a context of, say, technological optimism, ongoing monetary expansion that fuels currency debasement concerns, and continued weakness in major fiat currencies like the dollar.
So it's the primary asset for optimism about future systems, maybe escaping the old ones.
That seems to capture the dynamic, yes. Future systems, future technology, and maybe a future less reliant on traditional monetary policy.
This really helps crystallize that core philosophical difference you mentioned earlier.
I think so. Gold feels like the assurer. It's the conservative defensive bet. It's banking on timeless economic principles, prudence, stability in the face of the ultimate unknown crisis.
And Bitcoin then is the activist.
I like that. Bitcoin is the activist. It's the offensive, forward-looking bet. It's a bet on the future of decentralized finance, the ongoing digitalization of everything, and it carries that potential for superior performance driven by its early-stage adoption and high-growth dynamics.
Which logically leads us to the really crucial conclusion for you, the listener, the individual investor. The choice isn't really gold or Bitcoin, is it?
Exactly. That's the wrong question. The real question is, how much should I allocate to each, given their very distinct roles in potentially mitigating different kinds of future risk?
So they can coexist in a portfolio.
Not just can, but arguably should coexist in a diversified strategic reserve, depending on your goals and risk tolerance.
Okay, let's talk profiles then. For the conservative investor, someone primarily focused on preserving capital, seeking stability, what's the prudent path?
For that profile, it seems prudent to maintain a majority allocation, relatively speaking, to gold within their alternatives bucket. Allocations you often see discussed are in the, say, 5% to maybe 15% range of the overall portfolio, focused on wealth protection, stability.
Okay, and flipping that for the aggressive investor, someone seeking maximum growth, comfortable with high volatility.
Well, for that investor, a higher allocation to Bitcoin makes sense. Perhaps 10% or even more, again, depending heavily on individual risk tolerance. That allows them to potentially capitalize more fully on its high revaluation potential and that ongoing institutional adoption phase.
So the optimal strategy isn't about picking one winner, but about recognizing the unique job each asset does in shielding your wealth from different kinds of future threats.
Precisely. Whether those threats are the sort of historical ones, like governmental mismanagement of money, or perhaps future threats related to digital uncertainty or system change, they hedge different things.
Okay, let's try and summarize this deep dive then. Gold seems to remain that ultimate refuge in truly systemic crises. It's got historical proof, regulatory comfort.
Correct. And Bitcoin, meanwhile, holds the promise, the potential for superior, maybe asymmetric performance if, and these are big ifs, if institutional adoption continues to mature and global monetary expansion keeps going unabated.
So for you, the investor, the critical challenge really boils down to continuous education, doesn't it? And emotional discipline.
Absolutely. Staying informed on the regulatory landscape, really understanding the mechanics of both markets, how they trade, what drives them, and crucially, maybe most importantly, avoiding that gravitational pull of FOMO fear of missing out, and also avoiding panic selling during volatile periods.
Those emotional swings can be portfolio killers.
They really can.
Yeah.
Our analysis confirms the optimal strategy for 2025, and likely beyond, is allocation with wisdom. Informed allocation, not driven by emotion.
Okay, that brings us towards the end. We always like to leave our listeners with a final thought, something to mull over.
Right, so thinking about the long game, gold's biggest existential challenge might be remaining relevant to younger generations, people who are digitally native, naturally drawn to technological assets. Will they value gold in the same way?
That's a big question. Generational shift.
It is. Conversely, Bitcoin's challenge is perhaps transitioning its narrative, moving from being seen primarily as a highly speculative digital asset to being widely accepted as a legitimate, maybe even stable reserve of value, but without sacrificing the essential decentralization that actually gives it its core value proposition in the first place.
So, two very different challenges. One regulatory and reputational, the other perhaps generational and cultural.
Exactly. So the question for you to consider is, which challenge the regulatory hurdles and narrative shift for Bitcoin, or the generational relevance issue for gold? Which one do you think will truly define the next decade for these two competing and potentially coexisting assets?